Most traders would have entered this trade far too early. They saw price reach a key area and immediately started buying. But that's not how I trade. Instead, I waited for liquidity to be swept. I waited for confirmation, and only then did I enter the market. In this breakdown, I'll show you exactly how this simple process helped identify a high probability move before price delivered into its target. Before we get into the setup, let's first understand the market context. In the short term, price is moving downward and showing bearish momentum. However, if we zoom out and look at the bigger picture, the overall direction of the market remains bullish. So rather than focusing on the current sell-off, I'm interested in what needs to happen for buyers to regain control. That's why I'm following this bearish move closely and waiting for price to complete its objective before looking for any potential continuation to the upside. Now let's focus on these lows. Below them, there's a pool of liquidity resting in the market. This liquidity comes from traders who are already buying and placing their stop losses beneath the lows, as well as traders looking to enter short on a breakout. Smart money understands where this liquidity sits, and before any significant bullish move can occur, it's common to see price attack these lows first. So at this stage, I'm expecting price to move lower, sweep that liquidity, and collect the orders resting beneath these lows before revealing its true intention. As price continues moving lower, we can see this inducement forming in the market. This area encourages traders to believe that the current bearish move will continue, causing many of them to enter short positions or hold on to their existing sells. At the same time, their stop losses begin accumulating above the structure, while liquidity remains below the lows. This creates a perfect environment for smart money, because more traders become committed to one direction. Rather than reacting emotionally, I'm simply observing how price develops around this inducement and waiting for the next piece of the puzzle to form. After sweeping the liquidity, price finally reaches our point of interest. This is the area I've been waiting for, because it's where I expect smart money to become active. Notice that I'm not looking for an entry yet. A point of interest doesn't mean price has to reverse immediately. It simply tells me that the market has reached a location where a reaction is possible. At this stage, my focus is on how price behaves inside the zone. If buyers are truly stepping into the market, I should start seeing signs of strength and a shift in momentum. Until then, I'm remaining patient and letting the market reveal its intentions. Before looking for any confirmation, I always want to know where price is likely to go if this setup works. In this case, we have buy-side liquidity resting above these highs. This becomes my objective because liquidity often acts like a magnet for price. If buyers step into the market from our point of interest, then the most logical destination is the liquidity sitting above these highs. Having a target in mind before the trade develops helps me stay objective and gives me a clear expectation of what price is trying to achieve. After reaching the point of interest, price starts showing signs of strength, but I'm still not interested in entering yet. A reaction from the zone alone isn't enough because price can always continue lower. What I need is confirmation that buyers are actually taking control of the market. That's exactly what happens here, as price creates a clear market structure shift and breaks the recent bearish structure. This tells me that momentum is beginning to change. With liquidity already swept and the market now showing confirmation, this is where I become interested in executing my buy trade, rather than simply hoping for a reversal. Before we look at how price delivered into the target, I want to highlight a few common mistakes traders often make in a setup like this. The first mistake is entering the trade as soon as price reaches a point of interest. A point of interest is simply an area where a reaction is possible. It is not confirmation that the market is ready to reverse. The second mistake is ignoring liquidity. Many traders focus only on candles and patterns, but they never ask where liquidity is resting or where price is most likely trying to go. Without understanding liquidity, it's difficult to understand the true objective of the market. Another common mistake is assuming that a liquidity sweep automatically means a reversal. Liquidity can be taken, and price can still continue in the same direction. That's why confirmation is so important. Finally, many traders become impatient. They want to predict every move instead of allowing the market to reveal its intentions. By waiting for liquidity to be collected, waiting for price to react from the point of interest, and waiting for a market structure shift, we remove a lot of unnecessary guesswork and make more objective trading decisions. The goal isn't to predict the market. The goal is to wait for evidence and then follow what the market is showing us. So that's the complete idea behind this setup. We started by understanding the market direction, identified the liquidity resting below the lows, followed the inducement, waited for price to reach the point of interest, and most importantly, waited for confirmation before entering the trade. Once buyers took control, price delivered exactly where we expected it to go, into the buy-side liquidity above. Hopefully, this breakdown helped you understand the logic behind the move. If it did, I'll see you in the next analysis.